All right, thank you to that last panel. Go hunt down Amin if you want to find one of these masks. I've got nothing but feedback that they're super creepy. But anyways, let's keep it rolling. Our next speaker is Nuelle, partner of ventures at Galaxy, and he'll be talking to us of how DeFi will change the way banks create money. So round of applause, please.
Watched it. I'm sorry.
Okay. No worries. Okay. Thanks everybody for coming on Friday afternoon. Last year, I gave a presentation about block space and some of the economics around block space. Selling actual underlying compute power of blockchains. Thankfully, I feel like we've moved on, and a year later, I can now talk about applications of blockchains in a way that I'm really excited about. So the rough structure of the presentation, I'm going to walk you through 3 converging phenomena that I think are making up what will be a multi-decade mega trend with the adoption of stablecoins and DeFi collectively. And then I'm going to talk about 2 sort of under-discussed second-order effects of this trend. So first, one thing I'll highlight is the degree to which stablecoins are now being used as a savings instrument globally. I think it's well understood, but I want to highlight it, and I think it's quite important. The graph is a survey that was done by Castle Island Ventures, thanks Castle Island, that asks emerging market stablecoin users why they hold stablecoins. The second largest reason was to save money in dollars, right? People want access to dollars to save in their local currency, and we think this is an immense and growing trend. Exemplified by one of the portfolio companies in Galaxy's portfolio, who's sort of indexed to this trend, growing 14 times year over year in their ability to allow people to save stablecoins in emerging markets. The second one I'll highlight is the use of stablecoins as a payments instrument. I think it's under-discussed to what degree blockchains are being used as a cross-border payment rail. The existing system for moving cross-border payments across the world is, you start at a sender at a local bank. You eventually, through the correspondent banking system or a local domestic payment rail like ACH, or FedWire in the US, you get your payment to a SWIFT terminal. Then once it's on a SWIFT terminal, you pass the payment over SWIFT, which is really like a routing system and a messaging system, at which point banks in that SWIFT network reconcile with one another, and you can do 3-4 hops before eventually landing back in a sort of recipient country, and then finally in a domestic payment rail back to the end recipient. And that process can take 2 business days, 1 business day, 3 or 4 business days in lesser served market, and you can be charged a % of the actual payment or more, which is quite expensive. Just to speak to the size of the trend, so I keep a bit of a record of some of the companies which are generally called stablecoin payment orchestrators. And I keep a record of kind of the volumes that each are doing. And so this is an aggregated view of the volumes and the growth rates in this cross-border payment market. The 2 orange bars there are my Q4 2023 and Q1 2024 actual numbers. And then the black line is the black lines are the sort of implied growth rate or the implied size of the market if you just kept the growth rates from Q1 or Q4 and Q1 last year. The green bar is actually what we observed in talking with custodians and other players in the market in terms of how much volume there is annually. We think that's about 100 billion conservatively annual market in terms of passing stablecoins cross-border for non-crypto use cases. So businesses around the world paying suppliers and vendors with stablecoins. So this is a huge trend, and I think this is going to be a $1 trillion a year annual payment volume market within the next few years. And then the upside case is eventually, this is a $40 trillion a year market in terms of B2B cross-border payments over some time frame, and stablecoins are fundamentally better at doing this. The final trend, phenomenon which I think is worth highlighting beyond the first 2, which are more stablecoin focused, is sort of DeFi as a long-term source of above-market yields. For the time being, so if you look at the graph, you can see the Aave USDC interest rate, the Aave USDT interest rate. In the yellow line, that's the DAI stability rate. The green line is Athena. So recently, Athena, not to say that's a risk-free yield per se, but it is an example of sort of on-chain yield. And then the black line is the one-year treasury yield. So US government one-year treasury yield. And you can see, there are substantial periods, and I consider Aave USDC about as risk-free as you can get with respect to on-chain yield. And you can see Aave for vast periods of the last couple of years has substantially overperformed the one-year treasury yield rate. And if you look at, on the right side, there's two charts, which are the Ethereum TVL in DeFi and the Solana TVL in DeFi, but normalized for the price of ETH and the price of Sol. So it takes the price fluctuations of the assets out of the picture. You can see since sort of midway through 2023, we've been on a essentially linear uptrend after we drew down after the kind of 2021 market cycle. Really interesting, as I was looking at the data behind interest rates in DeFi, you can see that clearly in periods where Aave interest rates are below the one-year treasury yield, that's substantially restrictive in terms of on-chain assets. And you can see that period that in purple went from about 25 million ETH equivalents on-chain to about 12.5 million. So during that period where one-year treasury yields were outperforming Aave interest rates, on-chain interest rate or on-chain participation essentially went down by 50%. And then when you see periods of expansion where interest rates on Aave are above the one-year treasury rate, you get massive periods of inflows of capital. I think long-term, because of systems like Athena and other things on-chain, the interest rates on Aave will generally outperform the one-year treasury yield. And so I think of DeFi as a long-term capital sink as well, in addition to the two prior trends I mentioned. So just to give you initial takeaways, stablecoins are being used as a savings instrument in global markets. That's happening. From our index, that grew 14 times year over year. I think from some other indices, it's probably growing a little bit slower than 14 times year over year. The compounding on that would be out of control. But this is a really important trend about the adoption of stablecoins in emerging markets. Secondly, the use of stablecoins in payments. It's cheaper, faster to do payments, cross-border payments with stablecoins than over SWIFT in a lot of cases, not uniformly, but in a lot of cases. And there's a lot of great businesses, Bridge, which was obviously acquired by Stripe in the fall. Our portfolio company, Rail, used to be called Layer 2, is along those lines. And then the third takeaway, DeFi can be a long-term capital sink because of its ability to produce above-market yields versus sort of risk-free U.S. treasuries, in Aave. And so that all gets you to the actual adoption of stablecoins. If you look at the chart, we peaked sort of north of 150 million in 2021. And then you had a sort of drawdown as the market was impacted through 2022, 2023, and early 2024. But then through the back half of the year, I think these three trends are combining to ultimately just continue to increase stablecoin AUM. And I think there's no reason that this trend slows down. I think this is a macro decade-long trend where my projection is there will be more than 300 billion in stablecoins by the end of this year. And then the question from there is, at what point do we eventually reach sort of $1 trillion in outstanding supply of stablecoins, and what year that is? I don't have projections over that. I think the other thing I'd like to bring up, which ties into the rest of the presentation, is the degree to which stablecoins at this scale become a really interesting buyer of U.S. treasuries, and the sort of distortions that can create in the long term. You see in the the right-hand chart over here, and thanks again, Castle Island, for publishing this one. China is degrossing their stablecoin or their U.S. Treasury exposure at a rapid rate because of the sort of trade wars between the U.S. and China. And meanwhile, stablecoins are essentially filling the gap that China is leaving in the US Treasury market. And so without China degrossing, the impact of stablecoins as a buyer for US Treasuries actually has the impact of reducing interest rates for the US government to borrow. And then ultimately downstream to the consumer, potentially reducing mortgage rates and other things like that. So I want to talk about the two second-order effects now of this trend. If we say, okay, it's 300 billion by the end of the year, what are the second-order effects of this trend getting big? One is there's a substitution that's implied in the adoption of stablecoins as a savings instrument in emerging markets. In particular, it's a substitution of bank deposits in countries like Argentina to ultimately capital that flows into the US and into different places. So where before an Argentinian peso deposit in an Argentinian bank account would be 100% allocated to credit creation in an emerging market, now that capital is essentially being substituted, 80% of which is going to fund or to finance US government debt, 20% is going to US banks which underlie businesses like Circle. So Boney Mellon, Customers Bank, and the sort of aggregation of other banks that sort of sit under Circle's USDC product. And then for Tether, as many know, Cantor Fitzgerald and Deltec Bank and others, you don't always know. Now, what's the impact of this? The impact is banks are in the business of creating money, and so taking deposits out of an emerging market banking system could have sort of corrosive effects. And what I mean is banks are in the business of making money or creating money. Every deposit in a bank, as many people here will know, ultimately becomes a loan, which as long as that borrower is a customer of the bank, then it also becomes a deposit, and so on and so forth, the cycle goes. Historically, there's a concept of a reserve ratio that was 10% in the US, which meant like you could leverage your deposit base up 10x, so every dollar becomes a maximum of $10 of credit creation. The practical case post 2008 is reserves at banks are slightly higher, kept with the Fed, and so the delta between, or the ratio between M1 money supply and monetary base, M0, is about 3.3 times in the US, and in a country like Argentina is about 1.2 times. So if you just think about the impact of that, right? Now, there's an added component of credit creation. You've taken $100 of deposits in the Argentinian banking system, which created $120 of credit to Argentinian consumers and businesses. You instead financed $80 of US Treasuries, and then you put $20 of deposits in the US banking system, which have a 3.3 times multiplier for $66 of credit in the US banking system, right? So I think this is kind of a bit of a challenging story. There's maybe the even more nuanced view, which is it's not a simple substitution. Every conversion of an Argentinian peso into a US dollar is a sale of Argentinian pesos, right? You have to sell pesos to buy dollars, which are then converted to stablecoins on the back end. And so every time you do that, it has the effect of pushing the price of the peso down, which then reinforces the desire to hold stablecoins. Now, at small scales, that's not problematic. My calculation suggests, based on a Lemon Cash report, that stablecoins and crypto are about 1% of the Argentinian sort of M1 monetary base, so bank deposits and other things. And so it's small percentages now, but as that percentage grows, that has really material impacts on local economies and emerging markets. The other second order effect I'll highlight, and I have to move quickly here, is the one problem is the dual function of banks is to be both a custodian and a lender, and that's broken in DeFi. And so if DeFi were to continue to scale and stablecoins were to continue to scale to the levels that I'm talking about, it actually substantially impacts the amount of credit and money that's created in the financial system. Because every deposit in every MetaMask is essentially a non-custodial custodian, more or less, that then you put a deposit into a system like Aave, and you're lending it out on a one-to-one basis. A bank, you put $1 of deposit, and you're lending out in the US, on a 3-to-1 basis. And so it substantially impacts the ability to create credit in markets where DeFi is broadly adopted. So one proposal I have, and I think as we continue to go on this adoption curve, I think the 80-20 sort of reserve ratio between US Treasuries and bank deposits may end up getting shifted, where you get so much distortion of the US Treasury market with price-insensitive buyers who are willing to pay or earn lower interest rates than they otherwise should, while there's a dearth of capital then for private businesses and consumers, that eventually the stablecoin reserves that sit behind Circle actually get reallocated to more complex portfolios that include things like commercial credit and mortgages, et cetera, which then you've essentially used the backing of stablecoins to recreate a bank's loan portfolio. And so I think that's going to be one of the really interesting things we see in the future. So that's it. The three phenomena: savings, payments, and DeFi as a capital sink, and then the two second-order effects, which I talked about, which are the removal of deposits in emerging markets into stablecoins, which benefit U.S. Treasuries and U.S. banks, and then the long-term impact of DeFi not really actually creating money in the process. Banks create money. Aave does not create money, and I think that's a risk as we reconstruct the financial system. So that's it for today. Two thoughts to leave you on, and thank you very much.